Listen to AM 560 The Answer online at 560theanswer.com, on the AM 560 mobile app, on your Alexa-powered smart speaker, and on TuneIn, iHeart, and on Odyssey. If you're looking for the latest news, insight into what it means, and the sharpest opinion, there's only one station in Chicago where you can turn, and it's this one. We're AM 560, The Answer.
Top of the morning, Dan and Amy. This was an instructive exchange when Captain Kangaroo impersonator Janet Yellen appeared before the Senate Banking Committee and had a Q&A with Oklahoma Senator Jim Langford about fully insuring depositors at big banks like Silicon Valley, Signature Bank of New York, but not community banks. What are the implications of that? Let me make sure I understand what the policy is, and then let's talk about the implications.
So what is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No,
fail.
it's happening
And
because you're fully insured no matter what the amount is if you're in a big bank. You're not fully insured if you're in a community bank.
Yeah, it's pretty good distillation there. It's like, that's not our intention. Well, people respond to incentives, particularly financial incentives, and this is what you're incentivizing. You're incentivizing people to pull out of community banks and put their money in big banks that are systemically important because they know that the government is there to be a backstop. And if that's not enough of a kick in the teeth, this exchange about some of those uninsured depositors at Silicon Valley Bank.
It has been reported publicly that SVB had a large number of Chinese investors that are there, including some that were companies directly connected to the Chinese Communist Party. Will those individuals, companies, entities, and investors that are Chinese investors be made whole based on assessments in my banks in Oklahoma? So what I'm asking is, will my banks in Oklahoma pay a special assessment to be able to make Chinese investors whole from Silicon Valley Bank?
Uninsured investors will be made whole in that bank, and I suppose that could include foreign depositors, but I don't believe there's any legal basis to discriminate among uninsured.
No, but there's a legal basis to not insure the uninsured depositors above $250,000, but they've chosen not to do that, and so everybody gets caught in the net on the underwriting side, which would be Ma and Pa, Main Street Americans, right? You're going to pay the bank. Oh, nothing at taxpayer expense, really. You're going to pay the bank fees that bail out the uninsured depositors at Silicon Valley Bank and Signature Bank of New York and elsewhere. Very telling exchange between Langford and Yellen, just in case you were unclear about who the government is backstopping and who it is not, who your government represents and who it does not. For more on this, pleased to be joined by Alex Pollock, Senior Fellow with the Mises Institute, served as the Principal Deputy Director of the Office of Financial Research and the Treasury Department, also former President and CEO of Federal Home Loan Bank of Chicago, and he's got a new book, Surprised Again, the COVID Crisis and the New Market Bubble. Alex Pollock, thanks for joining us. Appreciate it.
Thank you very much, Dan and Amy. It's great to be with you as we have these interesting events going on in the banking system.
Interesting, indeed. What was your takeaway from that exchange between Senator Langford and Secretary Yellen?
It was very similar to the article. I just published an article this morning called the Silicon Valley Bailout in the journal Law and Liberty. in which I discuss, as is clear, every bailout means you're taking money from some people and giving it to others. And the thought occurred to me, as it did to you and to the senator. Well, that means that, let's say, the example I use is a small, careful bank in a small town in Wisconsin near us, who will be paying assessments so that the wealthy investors who were uninsured, who had over $250,000, which is pretty much money all by itself, can be paid off. You could substitute Oklahoma for that or any place else, but that's what it means. An interesting sideline on this, coming back to the title of the book, Surprised Again, is that all the agencies of the government, the Fed and all the bank regulators and the Treasury, have been assuring us for a long time that the banks are in great shape. And now we have these failures. So they, as well as we, are surprised again or yet again. And the answer is the bailout that you're discussing.
Well, yeah, but the question is that the correct answer? Is that the least worst option, I suppose? Because some, even those that are more conservative, libertarian-oriented, basically arguing, as actually Zero Hedge did, if the Fed does not contain the regional bank collapse, there will be another Great Depression. Small, medium bank accounts for 50% of U.S. commercial and industrial lending, 60% of residential real estate lending, 80% of commercial real estate lending, and 45% of consumer lending. So if there's a run on the regional banks and they're not bought up by the bigger boys, the way that Credit Suisse was just bought by UBS, then you got a problem in this country, another Great Depression, some are arguing. What's your reaction?
That's the argument that happens every time. Mm-hmm. And every time you do the bailout, you make the next bailout more likely, because
just one more bailout, Alex. We just need one more.
People count on it. Speaking of who pays, part of this bailout, is a new lending program from the Federal Reserve to banks which have large mark-to-market or large market value losses on their on the mortgage-backed securities and bonds that they've bought, and that lending program, the Fed will lend you more than the market value of your collateral. If that program has losses, under the program, it's the U.S. Treasury that takes all the losses first.
Right.
And the U.S. Treasury is the taxpayers, so we got the taxpayers directly involved as well as indirectly as customers of the bank. And bailouts always mean take money from somebody, as I said, and give it to somebody else. Well, is it worth it? Well, it's always a judgment call, and the central banks and the governments who do this can be certainly frightened by the sorts of doomsday scenarios you just quoted there a minute ago. But it seems like there should have been better cases that you could do.
Well, but then I mean, in given the circumstances as they are, then should we let it burn? Should we hope that the private sector intercedes the way that it did with First Republic and provides the deposits to keep regional banks of some import like First Republic solvent and operational, or what should we do?
That's a typical act. That was, you can bet, a discussion very much coordinated with the Federal Reserve and the Treasury.
Of course.
And those banks. And we don't know what the real deal is on that. All of these things are typical when we get scared. But one thing we do know, that you're right, since it is the policy that the biggest banks are too big to fail, as the saying goes. This tends to move deposits into the biggest banks. That's a very rational reaction on the part of the depositors. getting your money out of a failing bank is a completely rational reaction on the part of the depositors. But it's also a reaction which reflects market discipline. If you run your bank into insolvency, that's what you should expect. Now,
yeah. Well, and that's and especially with Silicon Valley Bank, that's the argument that's been made by many, including Larry Lindsay in the Journal over the weekend. That this was a management failure, and it doesn't mean that there are other banks in some potential peril, but because you had one bad management set here, or even maybe in Signature Bank in New York as well, where they're doing music videos instead of managing money and risk. Doesn't mean that the risk is systemic.
It doesn't. One of the really interesting things about this bailout, in order to cover a number of extremely large, extremely sophisticated, and wealthy people who had put their money into a Silicon Valley Bank, in spite of the fact that they can by no means be characterized as unsophisticated or innocent victims. They had to, or they chose to designate these as systemic risks. That's how they got around the limitation of paying out more than $250,000 per depositor. I don't know how many of your listeners have more than $250,000 in any one bank, but not too many, I guess. But these guys had up in one case to $3 billion put into one shaky bank.
Well, what about the bank regulators who are kind of asleep at the wheel? Are they going to have to pay for just letting this happen?
Well, they'll have some uncomfortable congressional hearings, as you were playing there, but otherwise, in that, they never pay, no. The regulators never pay. And this was
Well, will they be outed publicly? I mean, will we know who they are and what exactly they did or didn't do?
I don't believe so.
You'll see the scapegoating that you saw this weekend on Meet the Press when the squaw from Massachusetts, Senator Warren, had this to say about Jay Powell.
My views on Jay Powell are well known at this point. He has had two jobs. One is to deal with monetary policy. Yeah. One is to deal with regulation. He has failed at both.
Right. Would you advise President Biden to replace him?
Look, I don't think he should be chairman of the Federal Reserve. I have said it as publicly as I know how to say it.
It's all Jay Powell's fault, Alex. We just need to change out Jay Powell for some other banking mystic.
We have to say that the Federal Reserve, which includes Janet Yellen, term as chairman of the Federal Reserve, and Chairman Bernanke before her, all suppressed interest rates. So you might say it created the temptation for banks to do things as dumb as Silicon Valley did, and it's really fundamentally incompetent banking, which is have very short-term, volatile deposits and invest them very heavily, about 40% of the bank, into very long-term, 30-year mortgages at fixed rates. That's just getting a grade of F in Banking 101. Now, how did the management do that? Well, it's incompetence. Did the regulators who were regulating it, I guess they wrote it up as a concern. They should have seen it as basically replicating the mistakes of the savings and loans in the 1970s up into 1980 when they went broke by doing exactly the same thing, having a gigantic risk of interest rates rising. But the Federal Reserve seems to me culpable in creating the temptation by suppressing interest rates and claiming that they would stay low. This induces people to make the elementary mistake that Silicon Valley Bank made, but it doesn't excuse the mistake.
Well, and also when it comes to people like San Francisco Fed Chief Mary Daly, they're too busy playing politics to worry about things like bond valuations, climate change, George Floyd, Black Lives Matter, LGBTQ rights, and so on and so forth.
all of that is a distraction from what they're supposed to be doing. We can certainly say that. And that was true of the management of Silicon Valley Bank as well.
Right.
They got wrapped up in that.
Yeah.
Yeah.
Well, and I have to pay for it, and you have to pay for it,
and you have to
pay for it. Yeah.
That's exactly right. And you have to pay more than the deal was, and the FDIC, obviously, has to pay more than it planned on. If it had only to pay off the insured depositors in Silicon Valley, I believe it would have had no loss from Silicon Valley, because all of the loss would have been paid for by the large, uninsured, big depositors of wealthy people and firms. So instead, this has shifted huge losses. This bailout plan has shifted huge losses into the FDIC.
Well, what's your assessment of the banking system right now? Are we going to see a run of banks folding that are similarly situated to Signature Bank of New York or First Republic or Credit Suisse?
We hope those are outliers. The Fed hopes it ardently, but we do know that because of the temptation aforementioned created by the Federal Reserve's suppression of long-term rates and mortgage rates in particular, that the problem of having a big position of very short liabilities funding very long assets is quite common throughout the banking system. I don't know of any other cases that are as blatant as the Silicon Valley case, but it will definitely be a problem. Whether it would trigger a crisis, that's what you never know, but it doesn't seem to be the case.
All right, so stay tuned. He is Alex Pollock, Senior Fellow at the Mises Institute, former Principal Deputy Director of the Office of Financial Research at the Treasury, former President and CEO of Federal Home Loan Bank of Chicago, and his new book, Surprised Again, The COVID Crisis and the New Market Bubble. Alex Pollock, thanks for joining us. Appreciate it.
Thank you very much. Great to be with you.
Thank you, and he joined us on our turnkey.pro answer line.
This is the morning show more Chicago radio listeners are choosing. This is Chicago's Morning Answer on AM 560. The Answer.
Inflation is nothing more than legalized theft. Hi, I'm Dr. Ron Paul, and to preserve your wealth, I highly recommend keeping physical gold in your retirement account. To learn more, text the word SHELTER to 989898 to get a free info kit on gold IRAs from Birch Gold, which is the only gold IRA company I trust. So text SHELTER to 989898 to request your free info kit right now.
Windows and doors sticking, cracks in your drywall or brickwork, these can be signs of a structural foundation problem. Permaseal can help with that. Hi, I'm Roy Spencer. Many homeowners across Chicagoland and Northwest Indiana are experiencing the symptoms of structural foundation issues. Have you noticed uneven floors or gaps under your baseboards? Are there large cracks in your caulking or sunken concrete or soil near your foundation? These can be indications of an underlying structural problem. Before you pay an expensive consultation fee just to determine the problem, call Permaseal at 800-421-SEAL for a free inspection. The certified consultant will perform a professional inspection absolutely free of charge. When the work is done, you'll have a transferable warranty along with priceless peace of mind. For over 40 years, Permaseal has been making Chicagoland and Northwest Indiana homes healthier and more valuable. Be sure to check out our reviews with the Better Business Bureau and Google. Call Permaseal today at 800-421-SEAL. That's 800-421-7325 or permaseal.net.
Wesley Financial Group is not a law firm.
This story is called The Ugly Truth About Timeshare. If you think you've done your family a favor by buying a timeshare, you need my help. Hello, I'm Chuck McDowell, CEO and founder of Wesley Financial Group. 10 years ago, I started helping folks cancel their timeshare. And in the process, started what's now called the timeshare cancellation industry. Timeshare is the only thing that you can buy that you can't tell me how much it's going to cost or when it's going to end. When you buy a timeshare, you give them a blank check to fill out any amount they want for annual maintenance and assessment fees. The crazy thing is, this never ends. Even when you die, your family's now going to be stuck with this burden. Stop the insanity today. Call my office now. If we take you as a client,